A variety of revenue sources contribute to the government budgeting process. Ideally, a combination of several different sources of revenue will provide a balanced, stable flow of resources to support government operations. An effective blend of revenue sources allows sufficient stability to operate, develop and retain staff, and program activities necessary to effectively address public issues. Under a balanced blend of revenues, a temporary increase in one source of revenue will help offset cyclical or temporary declines in another source. Let's review the most common sources of state and local government revenue. Public revenue types include taxes, user fees, sales of products and assets, lottery and gaming revenue, intergovernmental transfers, debt instruments, balance carried forward, and other miscellaneous revenue. Each revenue source is governed by its own unique set of legal restrictions. Let's start with taxes. Most states collect a personal income tax, a corporate income tax, and a retail sales tax. In addition, many states allow counties and cities to impose local sales tax on top of the state tax. Property taxes provide a major source of revenues for counties and cities. Tax limitations have placed constraints on property tax increases in many parts of the United States. Increasingly, governmental jurisdictions at all levels are looking for new ways to generate revenues by charging for the services they provide to the public. The most significant characteristic of fees for service is that they cannot be used to fund general government services. Instead, the revenue from each fee goes into a dedicated fund that can be used to support only the activity for which the fee is collected. A number of government programs generate revenues through the sale of products and commodities. Other programs generate rents through the lease of properties. Lotteries currently operate in 43 states, in the District of Columbia, and several U.S. territories. Net proceeds from these lotteries are used to support job creation and economic development, public education, protection of the environment, public health, and a multitude of other public activities. The transfer of funds from one level of government to another, or between governments on the same level, is described as an intergovernmental transfer or intergovernmental revenue. Intergovernmental transfers provide a substantial portion of the revenues for many state, county, and local governments. Borrowing funds through the sale of bonds or other financial instruments is a vitally important source of revenue for state and local governments. While borrowing opens governments to debt liability, long-term financing provides an effective means of funding capital projects and other major purchases. Nearly all governmental jurisdictions require that general fund monies be spent by the close of the fiscal year. General fund revenue may be spent on any purchase under the control of the local government or district. In most states at the local level, the majority of routine governmental spending must be spent or reserved for spending within either an annual or biannual time frame. The tendency to underestimate revenue and to overestimate expenses frequently results in a positive year-end balance in the general fund. Whenever this occurs, the balance is carried forward into the next budgeting year as available revenue. Several other minor sources of revenue contribute to government finance. Fines and forfeitures provide a small but steady source of revenue to local jurisdictions. Fines from traffic and parking regulations are included in this category. Interest on invested funds also generates a small addition to governmental revenues. Using the 8 major categories of revenues, jurisdictions rely on quite different combinations to fund their public services.